So you've saved for retirement, you're ready to hit the beaches, you're almost ready to pull that plug, and now you're ready to go into retirement. But hold on a second, the stock market's starting to go down. So what do? Well, today I'm going to go through a series of these kind of seminal decisions that I had to make personally for my own retirement journey about what would happen in the case that if the market started to go down and your portfolio is out there in IRAs, would you be able to weather that storm? So in case you don't know, my name is Vincent. I do videos about retirement, primarily early retirement, because I'm in my mid-50s. And right now, I'm in a stage where I think I should be able to retire, and I've been kind of really investigating whether or not that's a possibility. So if you're like me, and watching this, you're probably wondering, like, what do you do? How do you set it up? And that's primarily what I'm doing. See, I just came back off a 2.5-month beta test of my own retirement journey. This is the way I plan to set up my retirement, and that incorporates a lifestyle and living in Southeast Asia. So I just came back, but in my opinion, you have to set it up into two pieces. You have to set up your retirement with the money stuff, and then you got to set it up with the mindset. So please like and subscribe. I like to do these videos about this kind of stuff. Hopefully it's going to help you, because making them has actually helped me a lot. So let's get on to the video. So today the question I wanted to really ask of myself and also of my portfolio is, if I retire in a bad market climate, would my portfolio be able to weather the storm, and will it recover enough in time so that I would have enough to retire? You see, if you look on the internet about people who are asking about retirement, primarily the question that seems to come up the most is, I have X amount of money, do I have enough to retire? Well, you see, it's all relative, naturally, but I think the thing that people have to really be concerned by is if your monies are set up in instruments like tax-deferred accounts and Roth IRAs, and you're very sensitive to market returns. And I wanted to ask, what would happen in a simulated environment if your portfolio was shocked so much to the point where it may had a really bad, what is called sequence of returns. So I'm sure you're familiar with that, and if not, please look it up. There's so many videos about it, but essentially it's a period where you're getting market returns that are negative upon negative. And I wanted to find out a period of time in history where that possibly had happened. So I asked ChatGPT, naturally, AI, and it came back with a decade period of 2000-2009, which I said to myself, that's perfect. Because in that period, if you don't recall, we had one of the worst attacks on US public soil since Pearl Harbor. And then compounded by the fact that there was a credit crisis, a massive one, where markets were almost down by 40%, and then on top of which a massive, very large investment bank went under. So I couldn't think of a better time period to test a portfolio, model portfolio. So my thinking was, if you are in this period of 2000-2009, a real bad sequence of returns, what withdrawal strategy is the best, the most optimal, and what asset allocation strategy coupled with that withdrawal strategy would be the best? And so I only really think of two withdrawal strategies. And by the way, I kind of find them to be really kind of onerous. And the reason being is that they require some setup and some implementation. So the two seem to be the most common ones are the bucket strategy and Guardrails. Specifically, I think it's called the Guyton-Klinger Guardrails. So let's go through each one. The bucket strategy is essentially setting up your portfolio in the manner that you have three discrete buckets. One is a short-term cash bucket, the other is a mid-term, like bond bucket, and the third one is a growth bucket, which probably is like stocks. And the idea is that you deplete the money bucket 1 and then rebalance bucket 2 and 3 depending on that allocation. So that's more of like a organizational kind of idea. The Guyton-Klinger model, or the Guardrail strategy, is more of a portfolio optimization idea. So the idea behind that withdrawal strategy is that if the market goes up a certain period, a certain amount, depending on your withdrawal strategy, which typically you start at 4%, which is the rule of thumb, you start at 4%, and then based upon how your portfolio is going, you increase by a percentage up or down depending on how the portfolio is doing. And I'll show you those assumptions in my model later on. But That's the essential idea. The question about asset allocation is really more about making sure that you're getting the maximum level of returns in your portfolio. Now, a lot of people, depending on where they are in their life cycle of retirement, will probably split it up in some combination of stocks and bonds. So this example that I'm going to show you, I wanted to see like a really heavy stock weighted allocation of 90-10 versus something a little bit more balanced, like a 70-20-10 model. 70% stocks, 20% bonds, 10% cash. And then see which one, based upon those combination of withdrawals, which one has the most amount of money in the portfolio. Let's walk through the analysis. I'm not going to go into the low level analysis of this because I'm going to share the spreadsheet with you, and feel free to copy it, tailor it to however you want. Something to bear in mind. These are models, and they are basically just petri dishes. Now, the thing about what I did in my particular case is I didn't incorporate taxes. And taxes is a major factor as you're withdrawing monies from your account. Is very, very important because you're going to have to pay that bill. Spending is all relative to your lifestyle. So whether it's $1 million or $10 million or even $100,000, it kind of doesn't matter that much because in the end, the model's still the model. You're going to withdraw based upon this framework. Let's go through some of the assumptions that I made. Theoretical person that has a $1 million portfolio, and essentially that person is retiring in the year 2000, withdrawing 4% on that $1 million, which is $40,000. Now, naturally, that's probably not the base case. Most people are going to withdraw more, but just for the instances of this example. We're going to adjust for inflation along the way on the returns. Typically, the average is 2.5, but if you see here, I have all the inflation returns that at least ChatGPT gave me. By the way, all of the sources of the information are in the spreadsheet in the footnotes. Okay, now that we've gone through the assumptions, also the kind of process of how the two strategies work, let's actually go through the numbers. So again, the most critical thing that I was concerned by was what is the ending balance going to be in the year 2009. So with the 90-10 guardrail strategy, the model's telling me $454,611. With a 70-20-10 guardrail strategy, it's higher at $607,341. With a 90-10 bucket strategy, we get to $574,156. In a 70-20-10 bucket strategy, we end up with $484,356. So none of these portfolios went to zero. However, in such a bad climate, the one that seemed to, at least this model is telling me, is doing the best is a 70-20-10 guardrails strategy. What it's saying though is that in a climate like this, the 70-20-10 guardrails is better, and with a highly weighted towards stock, the 90-10 bucket strategy is better. So again, I think all of this is about really kind of assessing how your personal needs are, what's easiest for you. I kind of found that the bucket strategy, maybe a little bit of, it works pretty well in practice if you have the discipline to keep redoing that rebalancing. I would just prefer to pull monies from just one place and spend. So there's just one last thing I'd like to make a footnote on. It's related to bond yields. So if you see the bond yields on the screen above, they are showing a wide range of returns. They are not yields. So for the decade 2000 to 2009, I'm showing a series of years where the bonds returns on those portfolio of treasuries range between 20% and minus 11%. And just as a disclaimer, those are total returns. Those are not yields, because the yield on a newly issued 10-year treasury during that time, during many of those years, in fact, was between 4 and 6%. Now, if you fast forward today, it's around like 4%. So just make a note of that. In order to calculate the variations for returns, that's what we're looking at. We're not looking at yields. Please like and subscribe to this video, and help me support to do other ones. I love doing this, and I'm going to do another one pretty soon about sequence of returns, but I'm going to do it in the Bolden software with my own personal account. So maybe we'll get a peek a little into that. Anyways, thanks for watching, and we'll see you in the next one.